Hard money loans get a bad name. Some folks hear the term and think of shady deals in dusty back rooms. That's just not the whole story. When used right, hard money can be the unsung hero that moves a deal forward, fast. This essay pulls back the curtain using plain, simple words. No hype, just straight facts. We'll break down what it is, who uses it all, the risks, all the benefits. My goal is to give you the honest truth so you can decide if this tool belongs in your toolbox. Sometimes an opportunity pops up that won't wait. A seller needs to close in 10 days. A diamond in the rough appears that banks won't touch. Hard money steps into the spotlight. So, what is a hard money loan? Let's break it down. First, short-term loan. Not a 30-year mortgage, usually 6 months to maybe 2 years. Second, asset-based loan. They care about the property more than you. Not your personal credit score, not your job history. They look at the value of the house or the building and the property's potential. They need to know the property can cover the loan if things go south. These don't come from big traditional banks. They come from private lenders, people or companies with cash on hand seeking returns. Because they're private, they don't follow the same strict federal rules. That lets them move incredibly fast and approve loans for unusual properties or situations. Quite the leaky roof or no kitchen, and a bank sees a problem and a hard money lender sees potential. Hard money fills a specific market gap. When banks are slow, committees, underwriters, lots of regulations. Bank loans can take 45, 60, even 90 days. Real estate moves fast. Deals can vanish in a week. Hard money exists for those moments. When banks say no or move too slow, hard money brings cash now. Banks lend umbrellas on sunny days. Hard money lends in a rainstorm. Urgency and imperfection welcome. The most common users of hard money loans are real estate investors. These are the folks who make a living buying, improving and selling properties. Specifically, the fix and flip community relies heavily on this type of financing. Imagine a rundown house at a great price. With $50,000 in repairs, you could sell for a profit in 3 months. Banks may not lend on heavy repair properties, especially if vacant. A hard money lender sees your vision, funds the purchase and often the repairs, because you have a fast exit plan. Another group. Buyers needing lightning-fast closings. If you can close in 1 week, the house is yours. Hard money can fund in days. It lets you compete with all-cash buyers. A strategic move when time matters most. Hard money is also used as bridge financing. Buy new now, sell old soon, then pay off the short-term loan. It bridges the funding gap so you don't miss out while other assets free up. Critically, not for typical long-term living. Over 10, 20, 30 years, high rates and short terms would be crippling. For long-term home ownership, choose a stable, low-rate bank or credit union mortgage. Hard money is a specialized tool for short-term strategic investment plays, not for settling down. So, how do these loans actually work in practice? The process is defined by a few key characteristics. First, terms are very short. Most are 6 to 24 months. You must plan to sell or refinance into a traditional loan before it comes due. Time is not on your side. The clock starts the moment you sign. Second, interest rates are higher. A bank might be 6 or 7%. Hard money could be 10 to 15% or more, plus fees. Lenders charge points at closing. 1 point is 1% of the loan. 3 points equals 3% off the top. Trade-off: you're paying a premium for speed, flexibility, and a lender who takes risk. Third, expect a larger down payment, often 20 to 30%, to show skin in the game and reduce lender risk. Underwriting is simpler, less tax history, more focus on appraisal and your plan. They evaluate purchase price, estimated repairs, and after-repair value. ARV. If the numbers make sense, they can approve and fund in 7 to 10 days. That speed lets you compete in hot markets and lock deals that would otherwise be out of reach. It's the question everyone asks: why are hard money interest rates so much higher? One simple word: risk. Greater risk requires greater return. Hard money lenders take on risk banks won't. Often lender of last resort, distressed properties, major repairs, borrowers outside bank boxes. Higher chance of default demands higher rates. They also have short durations. Banks profit over 30 years. Hard money has about 12 months to earn a return. To make meaningful returns in a year, the rate must be higher. It's about volume and time. Banks use cheap deposits to fund loans. Private lenders use their own cash or small pools seeking higher yields. Bank equals long game. Hard money equals sprint. Think tow truck. You can wait an hour for cheaper help or pay a premium to arrive in 10 minutes. You're paying for speed and convenience, urgent, non-standard jobs. Let's lay out the pros and cons in plain sight, starting with the good stuff. Number 1 advantage, incredible speed to close. In hot markets, speed can win, even over higher offers. Another pro, flexibility, not one-size-fits-all bank rules, less emphasis on credit if the asset and plan makes sense. It can save deals that would otherwise die. Now the expensive higher rates, double or triple a mortgage, and upfront points and fees. Those costs eat straight into your margin. Short repayment windows demand a rock-solid exit strategy. What if renos run long? What if the market cools? Payments keep coming at high interest. Miss your exit and you could face foreclosure and lose your down payment. Hard money is not forgiving if plans go off the rails. Knowing the downside is as important as the upside. No sugarcoating. This tool can make you money or cost you a bundle. Grab a cup of coffee, and let's keep it honest. Speed over rate is the trade. Use it wisely. At the end of the day, a hard money loan is a tool. Like a powerful nail gun. Used correctly, it helps you build something amazing, faster and more efficiently than a hammer. Use it carelessly, without understanding how it works, and you can do serious damage. The loan isn't good or bad. Its value depends on your skill, planning, and numbers. It makes sense when you've got an undervalued property, need a quick close, have a clear path to profit, or a fix and flip, often as a bridge to permanent financing. It's the wrong tool for long-term living, vague budgets, or no exit plan. Like that fast tow truck, it's great in a pinch, not for cross-country. Educate yourself, talk to multiple lenders, compare rates, fees, and terms. Final word. Hard money loans aren't bad. Bad planning is. Used correctly, they're a powerful tool. Used carelessly, they're expensive lessons.